Simple Roth IRA basics that everyone should know. After all, funding a Roth IRA is one of the very best things you can do for your future, because who doesn't like tax-free income in retirement? I've asked 1,000 people, and 1,000% of the time, tax-free is a yes, please. Roth IRA is the modern financial version of a very old story about growth. Yeah, the parable of the mustard seed suggests that from tiny beginnings, over time, exponential growth can happen. And what makes the Roth IRA particularly intriguing is that all of that growth can come back to you tax-free. Yeah, if you're a farmer thinking about planting a crop, maybe even a mustard crop, would you prefer to pay taxes on the seeds or taxes on the harvest? I would guess most farmers would say, hey, I'd rather have the harvest come back to me tax-free. And that is a Roth IRA. So if you're looking to grow your money and create tax-free income in the future, and you agree that hot dogs are better with mustard on them, then go ahead and hit subscribe. Thank you. I appreciate it. So I'm just going to go ahead and draw out a Roth IRA. So let's understand how they work. So let's start. Basically, a Roth IRA is just a big bucket. So we're going to draw out here a bucket, and this is called a Roth IRA. So a Roth IRA, there's some rules on when you can put money in and how you can take money out. So the first thing is you can put money in as long as you have earned income. And there's a limit. You can't put all of your money or a big pile. You can only put certain limits. So in 2023, that limit is $6,500. And if you're age 50 or older, you can do an extra $1,000 to $7,500. But that's all you can put in. So here we go. Let's say you put $6,500 into a Roth IRA. All right, so that goes in. Well, keep in mind, you do not get a tax deduction when you put that money in. In other words, it's as if you spent that $6,500 on a really fancy couch or, I don't know, vacation. I hope you go somewhere fun. But instead, you're funding a Roth IRA. $6,500 goes in, you don't get a tax deduction. So $6,500 goes in, and let's say we have a good year and it grows by $1,000, and now we're at $7,500. Well, while the money's in there, it grows and grows and grows, tax deferred, meaning you're not getting a 1099, you're not getting a tax bill on the growth along the way, which is cool. So it grows and grows and grows all the years, and then eventually, as long as you're age 59 and a half, you can take money out of this account. So here we go. Since you paid taxes on the front end, you didn't get a tax deduction on the front end. All the growth is tax-free. All of the money on the back end comes back to you tax-free. Pretty cool. So what does that look like over time? Well, I've created a spreadsheet to help us project what that could look like. So here we are. It's a pretty nifty spreadsheet saying, okay, what if we funded a Roth IRA from age 25 up to age 60? So that 35-year period here is our funding period. And we're putting $6,500 in, but again, that is modeled for inflation, so it grows over time. So eventually, we're putting in about $16,000 a year at your age 60. All right, so cumulative contributions over that 35-year period, here you've put in $377,000. A lot of money, but look at the account balance is over $850,000. It's over doubled. Yeah, meaning there's $473,000 of growth here. Well, what is the tax implication of all that? Well, the cumulative taxes saved is right down here. Assuming you're maybe in a 32% tax bracket, you've just saved over $150,000 in taxes by funding a Roth IRA. And guess what? You have $850,000 that comes to you tax-free in retirement. Pretty sweet. Imagine if you're married or if you have a spouse, yeah, actually, you could even double these numbers because both of you potentially could fund a Roth IRA. So if you look at $850,000, now you're at $1,700,000. A lot of money. That's pretty amazing. So fund a Roth IRA, and this is actually a pretty reasonable rate of growth. This is assuming an 8% rate of growth over time. So a reasonable rate of return over time. If you got 9, 10, 11, just imagine what these numbers could be. As you can see, the tax preference nature of a Roth IRA can be a big deal. But if we don't follow the rules, there are potential taxes and penalties. But one of the really big things about a Roth is the taxes and penalties really only ever apply on the growth, meaning what you put in, you can always take out tax-free, penalty-free anytime. Yeah, that's right. So in other words, if you put $6,500 in every year for, let's say, a 10-year period, at the end of that 10 years, you could call your financial advisor, your institution, take $65,000 out, tax-free, penalty-free. It's that simple. It's just the growth that has to stay in there until age 59 and a half, and it has to stay in there a minimum of 5 years. Beyond that, you're okay. So you can imagine your Roth IRA kind of like a hot dog at a hot dog stand. Yeah, so if you show up and buy a hot dog, you pay for the hot dog, but then you have all the toppings that come to you tax-free if you follow the rules. So you can put relish and mustard and pickles and onions. But if you break the rules of the hot dog stand, you're going to have to pay taxes on all of those toppings. Well, I don't know of any hot dog stands that have all that many rules, maybe in New York City. So there are 3 main rules, and the first is there are contribution limits. Yeah, you can only put in $6,500 a year, or if you're over 50, you can put an extra $1,000 to $7,500. But you can't put a huge pile of money into a Roth because the IRS knows it's a good deal. And if you're making too high of an income, the IRS says, well, you cannot fund a Roth IRA directly either. So if you're married filing jointly, it's about $218. Single, it's about $138. If you're above those amounts, you cannot directly fund a Roth IRA. The second main rule is that you have to be retirement age or 59 and a half before you can take that money out. So before 59 and a half, there's taxes on the growth plus a 10% penalty on the growth. But again, just on the growth, not what you put in. But as long as you're age 59 and a half, you can take that money out tax-free. And lastly is the 5-year rule, meaning you can take the funds out after the account has been open for 5 years. So age 59 and a half in 5 years to get the growth out tax-free, penalty-free. So there you have it. Pretty straightforward. Now that you know the ins and outs of a Roth IRA and how it works, you can determine if this type of account is right for you. So talk with a CPA, talk with a financial advisor. But as a financial advisor, I love these accounts because they can turbocharge your retirement and create tremendous tax-free income for you in retirement. Because whether you like French's Yellow or Grey Poupon, tax-free income in retirement is a good thing. Thanks for watching.